Today we got another special voice. So, first time ever, Sharad Pachisiya, who's actually the CEO of SageOne, is joining us. Of course, he's been around in the market for long in different roles. Currently, he is the CEO of SageOne PMS. Sharad, so nice to see you on the channel. Your first time debut on a business channel. Talk to us. What has been keeping you busy last couple of months? We all know, that, of course, that the AUM is growing on performance and inflows, but talk to us about some of the conversations you've been having with your HNI clients at the PMS last few months.
Thanks Ajay for having me on the show. Yes, this is my debut and good to be part of ET now to start with. So Ajay, in my capacity as the CEO of the company, we primarily deal with client relations beyond the operations of the companies. And last year has been a very interesting year, I would say, from deployment and from getting allocations from clients. As you're aware, it was a very tough year. We started with COVID, and that led to a lot of, questions in the minds of clients whether this is the right time to invest or not. So we had, engaging conversations with clients and made them aware that, volatility is something which is part and parcel of markets. If you extend your horizon of investments in markets, considering the times they are, we believe that the unknown component, of risk in the market kind of is discounted with the COVID, taking away broader markets beyond 25% in 1 month. So with that, we saw clients coming in bits and parts, and last year was in fact the best year for us in terms of raising money. We raised close to 300 crores across our clientele, and we typically deal with large family offices and UHNI. So I still believe that there are still a lot of people on the sidelines, but so far, it has been conversations around deployment, sticking to the asset allocation, and stay put to markets.
Right. Sharad, we also observed that in the last, of course, we are talking about life highs for the record indices, of course, but broader markets have outperformed a whole lot. SageOne and the entire category of PMSs is all about stock picking in the broader markets. Talk to us about your observations of the real economy, because these broader market companies are the ones which are really on ground, be it catering to domestic market or even catering to the global economy, because global economy is coming back with a bang, led by US, of course, but exports are looking upwards again. So if you could share some insights on your chats with some of these companies you have in your portfolio.
Certainly. So as you rightly mentioned, SageOne as a house, we thrive on stock picking. For us, having businesses in the portfolio of paramount importance, and what we really believe in quality businesses is what we pick. Broader markets do play a role, but for us as a bottoms of stock picker, certainly that doesn't pay too much of heed to. Net, we believe that if you stay put to businesses which have survived economic cycles and market cycles and have showcased their resilience, at the same time they have a brighter outlook in terms of earning performances and are able to maintain their moats, is what we want to stay put and continue to identify such exciting businesses which kind of depict and exhibit long-term structural stories. So, COVID did obviously led to a broader market rally. Post-COVID, you saw pent-up demand and everything under the sun moved up. But now it's the real time when, you would need to separate the men from the boys, because the benefit of pent-up, lower input cost is done with. Coming quarters, you'll see, companies will definitely struggle in terms of, the rise of input cost. How many of them are able to pass on the benefit? How many are able to even show volume growth beyond the pent-up demand is what is crucial. And at least the SageOne portfolio companies across our mid and small cap and small micro cap, they continue to show encouraging trends. The con calls which have been announced and the quarterly numbers which have been announced for the companies so far have been pretty convincing. Most of them are in line or beyond expectations. The good part is that we believe the businesses which are part of our portfolio companies, right from domestic manufacturing to businesses which also benefit from exports, continue to maintain the market share and in fact margins. And we believe that the coming 3 to 4 years, our expectations of earning doubling for the portfolio companies should fructify.
Right. Sharad, I see you are following themes like agrichem, specialty chemical, select pharma, and building materials, out of which agrichem and specialty chem already quite loved. Stocks have quadrupled, some of them last 2 years. Talk to us about what kind of pharma themes are you playing in your portfolio, and building materials, because pharma also, one section of the people say that if a recovery broad-based in India and globally, pharma may take a back seat. Others say that pharma will actually become even more center stage after this pandemic. People are shell shocked, and pharma or healthcare actually will become much more mainstream than it earlier was. And also your thinking on building materials.
Certainly. So Ajay, as a house, we don't follow a top-down approach. It's not the sector first which starts as a starting point. It is the bottoms-up approach, and certainly that morphs into a particular sector, right? So as you rightly mentioned, the companies which have fit in our criteria of superior earnings growth have been largely the companies from the chemical space. When I say chemicals, it's not the generic chemicals, it is the specialty chemicals and also the agrochemicals. On this front, we certainly believe that the businesses continue to show strong momentum. They are benefited by the underlying domestic manufacturing boom in India. At the same time, there are a lot of benefits from import substitution. At the same time, export opportunities going to China plus one strategy. Well, within pharma, I would say, pharma has a lot, has to be differentiated. It's not the generic pharma, the larger pharma companies where growth is a challenge. We look for pharma companies where they're benefiting either out of any specialty, any specialty intermediate they're making, the APIs they're manufacturing, or at the same time they benefit out of the CRAMS opportunity. So companies which are able to supply specialty APIs, intermediates to larger pharma companies, at the same time exports. And these are largely the companies in the mid and small caps, which have huge headroom for growth. They are growing at 20 to 30%, and we believe they can grow at 20 to 30% in the years ahead of us.
Sharad, one of your points is actually making me quite curious, and it is very contrarian in nature. You stayed away from metals. Now metals, major rally, in fact, one of the best performing after PSU pack for the last 1 year. Everybody latched onto it, almost became famous. But you have consciously stayed away from metals, that big cyclical. And even autos, another cyclical, you are looking at headwinds to continue in the midterm. What's your thinking behind this call?
Ajay, rightly put. In fact, Samit, who's our CIO, has come out with his latest memo about a couple of days back. And there he has beautifully analyzed how cement as a cycle pans out over, multiple market cycles. And, the final, I would say, conclusion has been that this sector has a lot to do with, the timing. And timing in and timing out both are important. Because this sector is, affected by not just domestic factors, there are global factors, and there are a lot of moving parts, which is beyond at least SageOne's, wisdom. And therefore, being away from such sectors is important because as I mentioned before, that, structural long-term trends are more important. Underlying businesses need to depict that. We really don't want to put our neck out and try to time in a sector where, the drawdowns can also be massive, right? So when it comes to managing money for clients, it is very, very important to stay focused on sectors which you understand the most. And with that reason, we kind of stayed away from cyclicals. Auto, I would say, was a sector which was certainly under our focus, and we have invested in auto companies in the past, auto ancillaries. But COVID certainly taught us one lesson that, that space is also something which is affected a lot by, how economy revives, because eventually that's consumption, right? That's discretionary consumption. And beyond the EV threat, which also is something, a big risk for a lot of auto companies. When COVID hit, we realized that, this sector also has a lot of dependency from the economy revival. And, staying in a sector where, you are dependent on how economy performs over the period is something we wanted to move away with. We had enough companies in our radar where, the growth was independent of how economies perform. And therefore, I certainly believe that is where, the construct of the portfolio is today. We would say that the safety net for us is the businesses which are not that, coupled with economy revival. At the same time, the ones where the earnings growth is being depicted in the past, and we believe that the earnings growth will be certainly depicted or exhibited more in the coming future.
Right. Sharad, I just want to understand the two portfolios which you're running, the strategies. What kind of 1 or 2 year forward earnings growth picture are you making now after you run your numbers, after the latest analyst calls and the result season? Does it give you visibility of 20 to 30% or 20-25% kind of earnings growth for your portfolio companies put together on aggregate?
Valid question, Ajay. So as you know, SageOne has two portfolios, the mid and small cap, which you call as SCP, and the small and micro cap, which you call as SSP. The philosophy is the same. It's just that the mid and small cap, we look for a larger market cap companies, and the focus is on a larger set of companies in terms of market cap. There our endeavor is to at least see companies doubling their earnings in the next 3 to 4 years, which largely is between 20 to 25% earnings compounding. Historically, that portfolio has grown in terms of earnings 30% CAGR over the last 9 years since we started managing the money. With our conversations to management, doing channel checks, our entire investment analyst team being focused on assessing the current state of the companies and the future outlook, we are confident. Standing today, we are confident that the earnings growth for the mid and small cap portfolio should be in the range of 20-25% over the next 3 to 4 years. And the small and micro cap certainly should be able to grow faster than the SCP portfolio companies. There, the endeavor is to grow our earnings. So at least the company should be able to grow their earnings, double their earnings in the next 3 to less than 3 years. So at a portfolio level, certainly the conviction, the comfort is there that both the portfolios will be able to meet their earnings growth.
And very quickly, lastly, are you looking at, or what are your thoughts on this entire unlock play, the leisure sector, aviation companies, travel booking platforms, resorts, hotels, airlines? What are your thoughts there? Is it, you may or may not have it in your portfolio, but any early thoughts?
Well, Ajay, we as a house largely look for confirmation and we don't try to preempt. The sector has some great companies, but as you know, the business has been disrupted because of COVID. We're keeping a close eye and we're watchful of the events, how they pan out. But standing today, taking a call that whether the earnings will come in the next 1 quarter, 2 quarter will be premature. So as we speak, we don't have any companies or businesses where they are deeply impacted by COVID.
Right. All right, Sharad, so nice to have you on the channel. Look forward to chatting with you, interacting with you more often. Thanks so much.
Pleasure is mine, Ajay. Thank you so much.
That was Sharad Pachisiya of SageOne.